If you or your household earns $150,000 gross per year, your maximum mortgage qualification might soon be the maximum of $675,000. That will be a reduction of $130,000 of potential mortgage money borrowing, period. No exceptions. No credit is perfect. No, but I have extra savings. It's just 4.5 times the amount of income that you earn exactly. Now, this isn't happening yet, but Canada's banking regulator is testing a system right now that could replace the current mortgage rules by 2026. And here's the wild part: some of you would qualify for potentially actually more money, while others would qualify for less. And most people have no idea this is being discussed. Now, in the next 20 minutes, I'm going to walk you through the simple new rule and how to calculate your overall maximum qualification: who wins, who loses if this happens, and what you should do right now before this kicks in. Because whether or not you're buying your first home, moving up, renewing, refinancing, or you're just trying to understand how this all works, this could help you avoid a massive mistake. Now, as I go through that, I will articulate the fact that this actual LTI requirement that I'm talking about already exists, and it exists behind the scenes with the banks. The big question is whether or not this will be directly impacted into underwriting or just how banks have to figure out how much money they can lend. Okay, first, I need to actually explain that this rule already exists because most Canadians have no idea that you're actually being tested by it, and they have been for about 2 years right now. Now, right now, when you apply for a mortgage in Canada, you don't just have to prove that you can afford your current payments. You have to prove that you can afford a higher payment, about 2% higher than the rate that you're actually getting. This is called the stress test. And here's how it looks in real life. Let's say you're getting a mortgage of 3.9%, not bad, but the bank doesn't care if you are getting a rate of 3.9%. They have to prove that you can afford payments at 5.9% because they're thinking, what if rates go up in the next 5 years when you have to renew? We just had this exact experience that's going on right now. We need to make sure that you are not going to go broke. So they're going to test you against yourself to make sure that you're preparing. So the math on a $600,000 mortgage goes like this: your actual payment at 3.9%, it's about $3,100. What you have to prove that you could afford is about $4,000 per month. That's a $900 difference on the money that you'll never actually pay. That extra $900, the money that you're not spending, is what determines if you get approved or not for a mortgage right now in Canada. Now, here's the problem: the system was supposed to protect people from borrowing too much. And in some ways, for sure, it worked. When rates jumped from 2% to 5%, even 6%, we didn't see any massive defaults because people were stressed, but they actually still survived. But here's what the banking regulators actually noticed: even though people passed the test, they were still borrowing 5, 6, and 7 times their income. And we've reported on this before when rates were super low. So when rates did jump, those people are faced with massive payment increases at renewal and are going to be for the rest of 2026. Not defaulting, but it affects their real financial strategies. Now, imagine you're making 100 grand and you borrowed $650,000 when rates were 2%. That's 6.5 times your income. That was definitely doable a few years ago. You passed the test at that time. Everything was totally legal and above board. But when you went to renew at 5% instead of a 2%, your payment jumped from $2,800 to $4,400 per month. Also, very plausible, very reasonable. That's a $1,600 difference per month, $19,200 per year, and almost 20% of your gross income gone, wiped out just like that. Now, maybe the government might be thinking like maybe we're just testing the wrong thing. Maybe instead of asking, can you afford the higher interest rate, we should be asking, are you borrowing too much compared to what you earn? And this is where this new system is kind of coming in. So hear me out here. Now, this is where it actually gets interesting because the new rule they're testing is simple and you can calculate in your head. You don't have to ask, how much do I qualify for anymore within, well, depending on the debt that you carry. And the proposed new rule is called loan to income, or LTI for short. Forget the name. All you need to know is this: take your household gross income that's qualified. That's the part that you won't know yet, but unless you have a salary, multiply that by 4.5 times. That will be the maximum potential mortgage that you could borrow under these new guidelines. That's it. Not a lot of complicated math required there. No buffers, just 4.5 times the amount that you borrow. For example, if you have $80,000 of income, your max mortgage is 360. With 20% down, you could borrow a $450,000 property. You could buy a $450,000 property. Your household income as a couple is 150, max mortgage $675. With 20% down, max home about $843,000 and change. Higher income family, $250,000. Max mortgage is 1.125. With 20%, you're getting a home up to $1.4 million. Now, this includes everything secured against your property, your mortgage, your home equity line of credit, all of it. So if you earn 150 and have a $600,000 mortgage plus 75 HELOC, you're at exactly 4.5 times your cap. Now, here's where the twist is, and this part is huge. This rule doesn't apply directly to you. It actually applies to your bank. Let me explain kind of what I mean by that. Each bank gets told by the government only X percent of your new mortgage this quarter can go above 4.5 times your income. And that percentage is a secret. It varies by bank. So you'll have no idea whether or not how much that is and whether or not they're at their cap or anything, which matters because let's say you earn $150,000 and you want to borrow 750, which is 5 times above your income, and that's above the cap. And you go to TD, they say, sorry, we can't approve you. You might think, okay, I don't qualify. I need to borrow less money. But what actually happened here is that TD hit their quota for loans this quarter, and they're actually full. They cannot go above the 4.5 anymore. You walk across the street, Scotiabank, they approve you. Why? Because they still have room in their quota. Same person, same income, same mortgage, just a different answer. And you would never know why, because practically speaking, I imagine most of the people that are there probably wouldn't know in the first place. But even if you ask the question, you might not get a fair answer. Right now, according to the Bank of Canada, only 12% of mortgages are above 4.5 times income. So 2 years ago, when rates were low, it was like 26%, which is mental. So most people are not hitting this cap right now, but as rates fall and people can afford more, those numbers are going to creep back up. And that's basically what the government is watching for. If you're listening to this while driving, by the way, or working, here's the key takeaway. 4.5 times your annual income equals your maximum mortgage under this new system. Grab your phone later and calculate it. It's really simple. Okay, so if this actually happens, here is the multi-million-dollar question. Literally, are you better off or are you worse? Now, number one, winners, high income earners in affordable cities. So if you make good money and you live somewhere like Calgary or Edmonton or Winnipeg or parts of Montreal, you might actually qualify for more. You earn $200,000 buying at today's rate of 3.9% under the current rules. You have to prove that you can make payments at 5.9%, which might cap you at 825. Now that's assuming standard guidelines of 39 and 44% GDS and TDS. We all know there are some exceptions to that. Under the new 4.5 times rule, though, none of that matters because you can borrow up to $900,000. And the difference is equal to an extra $75,000 of borrowing power based on these rules. This still begs the question, is this going to be the rules for CMHC-backed loans, for 20% conventional loans? There's a lot of questions here, but basically under the new system, the rates don't even matter. It's just your income. And this is especially true if the rates drop to 3.25% or lower. At that point, the gap between your real rate and the test rate becomes even bigger. So the new rule actually can help out even more. Now, the loser here is, big surprise, lower income earners. These are the people that get hurt the most everywhere, it seems like. You earn $80,000, which I don't even think is low income, but relatively speaking, you have $30,000 in car loans and credit card debt. If your debt ratios work right now, you might still qualify for up to $425. Purchase price. The underwriter has some level of flexibility. Under the 4.5x rule, you've got a hard cap at $360,000, which is $65,000 less borrowing power. And the current system gives underwriters the flexibility to look at the full financial picture. The new system is basically just math based on the way they're explaining it. No, but I'm paying off this debt soon. No, I'm not. I'm getting a raise soon. Just 4.5x income, depending on whether or not they've complete or build up their bucket. Another loser would be Vancouver and Toronto buyers. And this is where it gets really freaking painful. In Vancouver and Toronto, the detached home, your average detached home costs about 1.9 to 2.5 million bucks, which is wild. To buy a $1.8 million home under the 4.5x rule, you need a $400,000 income. According to StatsCan, only 4% of Canadian households earn that kind of money. And under the current rules, a household earning $300,000 might qualify for a $1.8 million mortgage if they can handle the higher test payment. Under the 4.5x rule, you're now capped at $1.35 million. Now, I talked to a couple last month, anecdotally speaking, both doctors, their combined income was about $350,000 on paper. They're trying to buy in Vancouver, and under the current rules, they can stretch to about 1.9 to $2 million from a mortgage perspective, capped at about under the new rules, they'd be capped at about $1.575 million. And they said basically like we're being punished for living in Vancouver in an expensive city. And honestly, the truth is kind of yeah, they would be if that were the case. So the truth is they didn't have a problem today, but they could. So who's mostly going to be okay is ideally move up buyers in those kind of medium price point markets. If you're selling that $800,000 property with $400,000 equity because you've owned it for 8 to 10 years and you're buying at 1.2 million, you need a $400,000 loan, you earn about $180,000 as a family, you would be okay. You wouldn't have any problems. Most move up buyers that I've witnessed in the market who've owned a house since say 2019 or before, they're usually okay because they've built up enough equity. Okay, so here's where I need to tell you the truth about what's actually happening right now because it's a bit different from what everybody is assuming if you've seen this reported and you're understanding how this rule works. Now, I didn't personally get a chance to talk to 5 executives, but I do know someone who did. And in the past week, they had a very mixed bag of feedback. Most of them were big bank executives or mortgage companies, with a couple of underwriters I personally spoke to. And I asked them all the same question: how much is the new LTI 4.5 times rule going to affect underwriting mortgages right now? But every single one of them said the same thing. As of today, probably very little. Most of the reasons for that is because most people aren't really trying to borrow 4.5 times their income anyways, according to a lot of these banks at today's rates around that 3.9%. Monthly payments are expensive enough that most people couldn't afford to borrow 5, 6, 7 times the amount they're looking at, which means like the market was limiting the amount that people could borrow anyways. So just a small percentage of people were actually going to be affected. The second reason is that the current test isn't stopping many people either. At 3.9%, having to prove the 5.9% is annoying, but most qualified borrowers pass it. It's not really a huge barrier like it was when rates were 6% and the stress test was 8%. The third reason is that only 12% of mortgages actually exceeded the cap, which is the stat I had mentioned earlier. With only 12% of mortgages going above the 4.5 times income, that's down from about 26% from 2 years ago. So the thing is, if neither of these rules is really stopping Canadians, why does this even matter right now? There are a few different reasons. Number one, if rates drop to 3.25%, suddenly the current test becomes super easy to pass. At that point, the 4.5x income becomes the main limit on borrowing. More people are going to bump up against it. Banks are going to hit their quotas faster. Getting approved over the cap is going to be harder. One of the lenders mentioned that if we see 3.25% rates, the LTI rule will start constraining lending in a meaningful way. If rates were to surge to 6%, and this is a lot less likely, but if rates were to spike again, say another inflation surprise, the 4.5x rule actually could help you qualify for more money if it was used in inverse. And that's because, truthfully, if you had to qualify for a mortgage at 7% or 8% or something like that, you would qualify for substantially less than 4.5 times your income. Now, in the third scenario, and this is where we are right now, neither rule is really the limiting factor, and the banks aren't required to prove this under underwriting this very moment. All right, so that's enough theory. Let's talk about exactly what you should do right now because doing nothing is actually also a decision that you're making. Now, if you're buying in the next 6 months, I would highly not recommend for the rules to change to look into this. And the reason for that is because it's not certain. Listen, the government banking regulators said, this is OSFI, said that they like what they're seeing with the new system, but that doesn't mean that they're definitely replacing the current stress test. They could easily keep it entirely, which is what everyone's assuming. They could keep both systems running in conjunction. You'd have to pass both the LTI and the stress test, which would be even worse. They could modify the current stress test and keep the new rule as a backup plan, or they could do nothing at all. And we don't know which one they're going to go with and how they're going to implement this, just that something will be implemented. A second reason is that you might not benefit from the rule changes. And even if they do replace the current system, you actually might not qualify for more money. If you need to borrow 4.5 times your income, you're kind of gambling that your chosen bank has that quota available if they use that for qualification, and that rates don't rise before you close on your property. Prices don't jump and eat up that extra borrowing power. The mention here is not necessarily to scare you into making a move now. It's to be conscious because if you didn't know in advance, then you can get mad at me and say, I didn't tell you, but now you can't. The third reason is that every month you wait is a month that you could obviously, if you're trying to be a homeowner, you could be building equity instead of paying rent, or at least locking in to figure out what the options are, or figuring out what your qualification is, which basically means know where you stand today so that you can determine what you want to do for later. If you qualify under today's rules and you feel comfortable with where things are at and you want to buy a piece of real estate because you're going to hold on to it for a long period of time anyways, then it's probably a decent time to find out where you're at right now. And if you're not sure where you stand, you want to do one of two things. You want to calculate where you stand, which is 4.5 times your income. The other option is you want to look at the current stress test, which is to calculate the monthly payment at the current rate. So let's say rates are 4%. You want to calculate a 6% and see if you can afford that at 39% of your gross income. Now, if you don't know how to do that, if you look at the link below, follow me on Instagram at The Mortgage Pug, type in qualify, and I will send you the calculator to determine what you qualify for or help you out if we need some help. Now, the new rule is really simple. Take your household income, multiply it by 4.5 times. That's your maximum mortgage. Now, the best thing you can do here is just compare the two options and figure out where you stand. And basically, if you're close, then you could probably do whatever you want. If one is much higher than the other, then you know where the constraint is in making a decision. Now, if you have a renewal coming up in the next 6 to 12 months, the good news is right now, in the next 6 months, it probably doesn't affect you. Renewals, staying with your existing bank, it doesn't, you don't need to requalify. You're renewing existing debt and you're not taking on a new debt. But the time it does matter is if you are refinancing to pull out equity, restructure it, reduce your payments, change the amortization, or move, typically speaking, to another lender. But there is that one reminder, last one, that if you're planning to switch lenders, as of November 21st, 2024, the government already removed the current stress test for current switches. So if you're moving from one mortgage company to another mortgage company, as long as you qualify, which is the key to all this stuff because not everybody qualifies, then it should make it relatively easy. Honestly, the best thing you could do right now is really simple. Figure out where you stand and look at what your goals are right now. So, when we actually find out when this is changing is the question, because I know some of you are thinking, should I just wait and see what's going on? The government actually said that their timeline is anywhere between January 2026 to spring 2026, which basically means we're probably looking at February or March for their assessment, with the final decision being somewhere between April through June, which is roughly about 3 to 6 months from today, with the four possible outcomes: replacing the stress test, keeping both systems, modifying the current stress test, or doing nothing at all. And from the lenders that we're talking to right now, what we're hearing is they wouldn't spend this much effort just to scrap it. So chances are something is going to change. The regulators basically said exactly this: we like what we're seeing, it's working as intended. My best guess is that they'll at least change or modify the current test, if not eliminate it entirely. But my guess is not certain. And honestly, my biggest piece of feedback is we wait to watch what happens in February or March of 2026 from OSFI to see exactly what they end up doing. What it means for you, bring it all home. If you're a buyer, if you can qualify today, find out where you qualify. Look at, lock in a pre-approval, get your numbers fully underwritten, because at least you know where you stand. If you're selling, it doesn't really affect you. The price of your property is subject to the demand of the property that you're looking at. And for everybody that's just generally curious, take your income at your gross that you think would be qualified, times that by 4.5 times percent of your income, and you'll find out what you could qualify for if these rules change. The bottom line is that Canada's mortgage rules might change by spring of 2026. And if they do, some people will benefit, mostly high earners in more affordable markets, and others will face some tighter limits. But right now, at today's rates, neither the stress test nor the 4.5x is really stopping the average person. Again, 88% of Canadians are not going to go above that anyways, so you're probably going to be doing just fine. I'm going to be watching to see what happens over the course of the next few weeks, to see the actual rule, how it rolls out, how the banks actually approach this, and obviously make sure to report as much as I can. Now, if you want to stay ahead of what's going on in the Canadian real estate market and cut the bull crap, make sure to subscribe to the channel. And like I said before, follow me on Instagram at The Mortgage Pug, and I'll see you on the next one.